All right, guys, let's get started. So, session two, I hope you really enjoyed session one. Been some amazing feedback. I really appreciate that. Um, so, thank you for those guys that have been emailing me and reaching out to me. That's awesome. And I'm really glad that you guys got so much out of session one. And we've got lots of good stuff to come today as well. So, we're going to be looking at some trades from 2017, be walking you through those and talk about what's coming next. All right, so just a quick disclaimer that any information contained in this presentation is for educational purposes only and nothing is to be considered an investment recommendation. And all trades and all trading results covered in this presentation may not be live trades. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Do your own due diligence, guys, at the end of the day, and make sure you check out the options disclosure document, characteristics and risks of standardized options available from optionstradingiq.com/risks. All right, so let's get into the meat of today's session. So we'll get straight into it. Here we've got the Iron Condor trading plan. Okay, so you guys should have a copy of this. If you don't, just email me, I can send that to you. I'll also make these slides available for you guys as well. So this is the plan that I trade. Basically, we've got some objectives there. We want to try and aim for 15 to 25% return, try and be profitable on 10 out of every 12 months, roughly 80% of all trades. Okay. Also got there, keep a trading diary and review it weekly. So that's really important. Commonly overlooked factor. It's kind of boring. It's not sexy, keeping good details and keeping a sort of a journal. But it actually does make a real difference in your trading. So that's something that I'd encourage you to do, something that probably 90% of people don't really do very well. And I can help you with that if you're interested. But it does actually make a big difference. So those are the instruments we're going to be trading: Russell, SPX, NDX. I do occasionally trade some stocks as well, but typically I'm just trading the indexes. There's less stock-specific risk. You get these earnings jumps. Apple's up 6% after hours. Netflix was up huge a couple of weeks ago. That's really risky if you're trading iron condors on individual stocks. There's a bit less risk of that sort of thing when you're trading indexes. Indexes are also cash settled, so there's no the European style, so there's no risk of early assignment. So that does make a difference as well. And there's also some tax advantages as well for the guys in the US. In terms of capital allocation, the maximum that we would go to would be about 40,000. So this is on a sample $100,000 account. So you'd never want to risk your entire account on iron condors. That'd be a bit crazy. So the most you'd ever want to go to is about 40,000. And I've got here, trading that will focus on monthly condor trades between 30 to 45 days left to expiry, with the aim of generating consistent monthly income while minimizing losses. So as I said in session one, I've actually recently, over the last couple of years, been moving further out in time. Volatility has been really low, as you guys know. So those shorter term trades, you have to bring those strikes in really close and you don't have much margin for error. If you go a little bit further out in time, you can place the strikes a bit wider, and the trade also moves a little bit slower. So you've got a bit more time to adjust. And that's really good for me. Being based in Australia, the markets are open 11:30 p.m. till 6 a.m. in the winter here. So, not ideal for sleep patterns. So I need a trading strategy that I don't need to be in front of a computer the entire time that the markets are open. So, for example, I might put on a 60 or an 80-day condor, and it might only need one or maybe two adjustments over the course of the trade. So, I can definitely handle getting up once or twice in the middle of the night in an 80-day period, or I'll stay up late one night and make my adjustment if I need to, or I'll get up early. So it's a really low intensity style of trading, I guess. You don't have to be, it's not day trading, you don't have to be in front of the computer all the time. So in terms of our entries, we're looking at delta of our short strikes around 8 to 10. I'll even go as high as sort of 12, sometimes 15, but usually that sort of 10 to 12 range is kind of pretty good. You guys should hopefully know what that means on your short strikes. Try to open the position on a down day, so when volatility is a little bit higher, just allows us to bring in a little bit more premium, or if we're bringing in the same amount of premium, we can put the strikes a little bit further apart. So implied volatility is really key to have a good understanding of that. So that's something that I'll go into a bit more detail on shortly. We want to aim to enter the sold strikes below support and above recent resistance. So we're looking at technical analysis as well when determining our strikes, and we're trying to aim for at least 10% income per trade. So, if we're risking that full 40,000, we want to have at least 4,000 in income potential. Now, as I said in session 1, in this environment, I wouldn't go straight in and just go bang and have 40,000 at risk on day one. I might put 10,000 at risk on day one. Maybe the next week I put the second 10,000, the third week I put the next 10,000, and maybe I also leave a little bit of powder dry for adjustments, okay, if the trade starts to go against me. So when I say a 40,000 allocation, doesn't mean bang 40,000 all in one go. We're scaling into our trades, or layering, which was that concept we covered briefly in session 1, and something I'm going to talk a little bit about in more detail as well. So profit target 1,000, stop loss about 1,000, so pretty standard there. Sometimes we can go a little bit higher on those as well. And in terms of adjustments, this is really key, and something that I'll touch on briefly here, but something that we could spend a lot of time on, and I'll look to do future sessions on that as well if you guys are interested. But I have 4 main rules when it comes to adjusting iron condors. So the first one is I look at the spread value, and if it rises by 200%, I want to adjust the trade, okay? And there's very good reason for that mathematically. So for example, if I trade a condor and I bring in $100 premium on the call side and the put side, so 200 in total, okay? Then the market starts going down, okay? So our call spread's doing well, it's losing money, but our put spread's rising in value, which is a loss for us having sold the spread. So if the put side, as the market's going down, if that premium on that spread goes from $100 to $300, that's when I want to adjust, okay? So keep that in mind. That's what I mean when I say 200%. You can just apply that rule no matter what the spread was trading at. Short option delta, this is a really key one, something I'll talk about a lot today. If the short option delta reaches 20, at worst 25, I want to adjust, okay? And the reason for that is I've just seen it time and time again that once you let the short delta get above 25, and if the market continues to move against you, the losses start to snowball. They get bigger and bigger exponentially, okay? So up until the delta being 20 to 25, you might be in a little bit of a loss situation, but the loss is very manageable. It's very easy to adjust. And I see beginners making this mistake all the time, they hold on and they hope and they pray that the market will reverse, and it's just not a valid strategy. And then all of a sudden, let's say the market's going down, their strikes are at 1400 and the Russell's at 1405, they'll email me and say, Gav, I've got this trade, what can I do? And by that point, it's almost too late. There's very little you can do at that point. So the key is to really adjust it early before it gets into too much trouble. So that's really important to keep an eye on. Another rule I have is distance to the short strike. So if the underlying gets within 3% of the short strike, again, we want to look to adjust. And our delta dollar exposure, again, we talked about that a little in session 1. Really, really important concept and something that I monitor religiously. If that reaches plus or minus 80,000, that's too high. I want to adjust. I want to bring that delta level down. Okay, so those are 4 things that I look at. Now, if a trade goes against me and one of those factors has been hit, I might leave the trade. I might not do anything. If 2 of them have been hit, maybe I still leave it. If 3 or 4 of those things have been hit, I'm definitely adjusting, okay? So it really depends. You've got to have a little bit of judgment, but these are the 4 main factors that I look at. So really important to understand those concepts. Again, if you need a bit more detail on that, just shoot me an email and I'll be happy to help. All right, so moving on, the pro tip for you guys is something that I talked about earlier. The further out in time you go, the slower the trade will progress, okay? In other words, a 4 to 5% move in the underlying might see traders needing to adjust a monthly iron condor, a 30-day condor, but an 80 to 90-day condor might still be okay. All right. On the flip side, weekly condors move very, very quickly and leave very little chance for adjustment. So this is another big mistake I see beginners making. They get attracted to these weekly condors. They see this massive amount of time decay, this massive amount of profit that they're making in a single week, and they just get hooked and they think this is amazing, and they start selling these weekly condors and everything's going really, really well for 4 or 5 weeks, and then on week 6, you know, the market makes a big move and all of a sudden, bang, the trade's in a big loss, and they've given up, you know, the 4 or 5 weeks worth of profit. They've just given it up in a day. Okay, I see that mistake happening all the time. It's due to something called gamma, which again I won't really talk about today, but it's another pretty important concept. Again, if you want some more detail on that, just email me. I'm happy to help. But gamma is a risk that we have with options trading, and it's very, very high for short-term options. Okay, further out in time you go, there's less gamma risk. Okay, so gamma is basically just price risk. If the price makes a move, you know, how much is it going to impact the trade? So with those short-term trades, very, very high gamma risk or high price risk. 80 to 90-day trades, much lower gamma, so you've got much lower price risk. All right, another rookie mistake that I see people making is that while entering an iron condor after a sharp sell-off might seem like a good idea, that's due to the volatility spike, many times I've seen this lead to losing trades. Okay, in recent years we have seen many V-shaped bottoms with sharp rallies after some panic selling. You can go back and look at the charts and you'll see. If a trader was to enter an iron condor at the bottom of the market, the call spreads would quickly come under pressure during a sharp reversal. So yes, we want to enter iron condors when volatility is high, but we don't necessarily want to enter it when there's panic selling, because the selling could continue. It could continue much lower, or it could reverse sharply. Okay, I've seen a lot of traders in the last couple of years get into trouble. Most people with condors are worried about the put side. The last couple of years, most traders that have emailed me with problems have got into trouble on the call side. So a lot of times when you see those big panic sell-offs, you want to just wait a few days for the market to kind of recover a little bit, and then that's when to enter the trade. Okay, so you've got a little bit less risk there. Volatility is still pretty high because the market's still bouncing around a bit, so you can still get a good entry point, but you don't want to necessarily enter right at the bottom. The other thing you can do, if you're comfortable trading a little bit directionally, and if you're you know, confident in picking bottoms, very, very hard to do, mind you, but you can leg into your trade. So you get some of this panic selling, you might sell some put spreads, wait for the market to rebound, and then you end up selling the call spreads at a better price. So that's another thing you can do. But again, it takes a bit of skill, and you've got to be watching the markets pretty closely to try and pick those tops and bottoms. And again, you know, very hard to do as well to get that direction right. Okay, so let's go and look at some trades from this year. So here we've got a 49-day unbalanced iron condor on the Russell. So it's a little bit small here, but hopefully you guys can see that. Started on January 26th, the Russell was at 1375, and you can see the position here. So we've got the Greeks there and we've got the graphs. When I talk about having a trading journal and a trading log, this is kind of what I'm talking about. Whenever you put on a trade, make some notes, take some screenshots of the Greeks and the graphs, and you follow it along. Anytime you make an adjustment or something interesting happens in the market, again, you take the screenshots, maybe make some comments, and then you have this big database of trades. So that's really important. That's something that I find helps people out a lot, just in terms of locking in some of that knowledge. So one thing I've found this year, there's been a lot of skew. Again, another fairly advanced concept for some of you new guys probably, but you know, we can go into more detail on that later. There's been a lot of skew this year, so you notice this is an unbalanced condor. I'm selling 10 of the put spreads and only 7 of the call spreads. Okay, so these 1260 puts and the 1460 calls, they would have been around delta 10. Now, to get the delta to be more or less neutral on the trade, I have to trade less of the call spreads because of that skew. So you can see here delta is -4, delta dollars -5,400. Okay, more or less neutral, slightly negative. Now, if I had have traded 10 of the call spreads, I would have had a very negative delta. Okay. This is from Interactive Brokers, by the way. It's a broker that I use. Okay, so that's our starting position. You can see on the bottom there, the blue line, that's our expiration graph. You know, we've got about 2,200 profit potential in the trade. And if you look down to the bottom left, we're risking on the put side just under 18,000. So we've met that 10% minimum requirement. Okay, and that purple line is a week from today. So you can see if the market stays flat, we're going to make a little bit of money. If it starts to make a big move, that's what we don't want as Condor traders. That's where our risk is. All right, so we'll go forward to Jan 30th. So a couple of days later, Russell's dropped a little bit, falling from 1375 to 1352. The VIX has risen from 10.6 to 11.8, a rise of 11%. However, volatility is still very low. Okay, a VIX at 10 is quite low. I think the historical average is maybe 14 or 15. So we're in a really low vol environment at the moment. So we have to trade a little bit differently. But just going back to the trade, so far the trade is down about $100 compared to down $20 for the 84-day Condor. So we had a 49-day Condor and an 84-day Condor on at the same time for comparison. As I said, the shorter term trade has been impacted more than the longer term trade. The short term trade's down 100, longer term trade's down 20. Okay. With this trade, Delta has gone from -4 to +17. Vega's come down a bit. Delta dollars is 23,000, so still within acceptable boundaries. In comparison, the 84-day Condor has Delta dollars of 10,000. So again, that longer term position hasn't been impacted as much. The delta on this one, you see we started at -4, it's now 17. So the market's gone down. We're now getting positive delta. We want the market to go back up towards the middle of that Condor. You know, again, bit of a refresher, that delta dollars number, very, very important. If we take that delta of 17, we multiply it by the index price, 1370. I think I might have been a bit late getting the screenshot or something because it was at 1352. But 17 times 1370.7 gives us our delta dollars. It's basically our notional exposure to the market or our dollar value. If the market goes down, let's say another 1%, this trade's going to lose roughly 1% of 23,000, so another $230. That's why it's important to keep that exposure low. If this delta dollars was 100,000 positive and the market went down 1%, we'd lose 1% of 100,000, so $1,000. Okay, it's not a perfect science because we've got other factors at play such as Vega, time decay and things like that, but it's a good rule of thumb. That's why it's really important to keep this delta dollars at the front of your mind and monitor it really closely. Okay, so at this point, the trade's still okay. You know, our delta dollar adjustment level was sort of 80,000. You know, sometimes I'd even adjust when it gets to about 60,000. You know, delta on our short puts and short calls is all fine. All of our risk parameters are okay. All right, we're only down $100. There's really no need to do anything with this trade at this point. Okay, let's go forward. So here's our graph. We've lost a little bit of money, but you see that purple line, that's now 2 weeks from today. If we stay flat, you know, we're going to be looking really, really good. We've got, you know, about 3% margin for error on the upside and the downside over the next 2 weeks. So we've got a pretty nice looking trade. We're pretty central. We've got 8% on that blue line to our short puts and 7% or just under on the upside to our short calls. So we've got a bit of margin for error. Trade's looking good. All right, Feb 6, we go for another week, forward another week. And Russell's almost back exactly where it started. Perfect conditions for an iron condor. Okay, so far this trade is up $345 or 1.93% of capital at risk. In comparison, the 84-day condor is up to 70. So again, that longer term condor, it's moving a little bit slower as well when we're making profits. Okay, the theta value is a little bit lower, getting a little bit less time decay because we're further out in time. Again, if some of these concepts are, you know, going over your head a little bit, if you're new, don't worry, just email me, I can help you out, no problem. I've got some videos you guys can watch and answer any questions on email as well. All right, so our Greeks look fine. Our delta dollars is plus 12,000 and our delta theta ratio is 13.6%. So again, that's another thing I look at. That ratio is totally fine. The delta of the short put is negative 8.75 and the short call is 6.86. That's well within acceptable levels, well below that sort of 20 figure that I'm looking at. Okay, so really, again, really nice looking trade. We're doing well. Been in the trade a week and a half. The market's basically gone nowhere. We've made a little bit of profit, and all our risk parameters look good. So here's our new graph. You can see we've got just over $2,000 left in income potential in the trade. That's our purple line 2 weeks from today again, or 1 week from today, sorry, looking pretty good if we stay flat. Nice looking trade, nothing to do here. All right, Feb 14th, so we go forward another week or so. Russell's gone up a little bit to 1396. Trade's doing well and is up 775, but is starting to pick up a bit of negative delta. Okay, you can see that there, negative delta of 23 or negative 31,000. From a portfolio perspective, it makes sense to adjust this trade and bring delta back close to zero. So what I mean by that is, if you remember in session 1, I talked about monitoring our trades individually with some of these rules and also monitoring them collectively as a group. So at the time, we had 3 trades on. We had a condor, a bearish butterfly, and maybe a trapdoor, okay? And they all had negative delta. So even though this position was okay, according to all our rules, I looked at the portfolio as a whole and said, look, I've got 3 positions with negative delta. I'm going to adjust this one and bring this one back to neutral just to reduce my price risk a little bit. All right, so what I did is I rolled up the puts to bring in some extra income and get delta back to a more neutral level. The adjustment has an added advantage of bringing in an extra $990 in income potential, so it's a fairly aggressive adjustment. So 2 types of adjustments, aggressive or defensive. This is aggressive. I'm rolling the puts closer to the market. I'm increasing my risk. I'm also getting paid to do that, so I'm getting some extra income. After the adjustment, the trade is more or less delta neutral, with delta dollars changing from negative 31,000 to plus 3,000. Theta or time decay has increased from 76 to 85, and Vega has also increased. So, you know, we've added a little bit of risk in terms of Vega. We haven't added any contracts, so we're still at the same margin. We've rolled a bit closer to the money, so we're getting a bit more time decay. Okay, so to roll, we buy back the 1260, 1240 puts, and then we sell a new spread higher up, as you'll see on the next slide. But before we go to that, just looking at this, the 1260 puts got a delta of negative 5, 5.5. See that there? There's about $500 in income potential left in the puts. So they're not doing us that much good down there, okay? And if I'm comfortable that the market's not going to drop really quickly, I'm happy to roll those up a little bit and bring it back to more neutral. So we'll show that adjustment now. So this is before adjustment. This graph, you can see we've got 4.5% margin on the upside, and we've got 10% margin on the downside. So the positions become a little bit skewed. We're not very central. So what we're going to do, the calls are okay. Our short delta on that was only 13, so those are okay. They're more than 3% away. You know, all of our rules regarding that, the spread value was all okay. So we don't need to take any defensive adjustment with the calls. But what we can do to get the trade more neutral is we can move these puts closer. So we get them from negative 10% up to about 7 or 6% from memory. Okay. So after adjustment, we've closed out those 1260, 1240 puts, and we've sold a new spread at 1320, 1300. Okay, you can see their delta 14.5 gets us pretty similar to our short call delta of 13. Okay, so much more neutral now. Delta of 3, delta dollars 3,600, 4.5% margin for error on the upside, 5.5% margin for error on the downside. Really back to a neutral trade, perfectly neutral trade. Okay, so you've got to decide what type of adjustment works best for you. I've got a list of 10 different types of adjustments you can make with iron condors that you guys can have if you want it. So here, after the adjustment, really nice looking trade, very central, delta neutral, all our Greeks look good. Okay, Feb 22nd, so another couple of weeks gone by. Trades up 1,500. The Russell again, it hasn't really gone anywhere. It's only gone up 10 points or about 1%. So that's exceeded our profit target. Remember that $1,000. But all of our risk parameters are okay. So I've said here it's fine to hold on to it for a few more days. So you can see that here we've exceeded our profit target, but there's really no need to close the trade. Delta dollars looks good. Delta's -7. We're more or less neutral. Delta of those 1320 short puts is 9.8. Short calls is 10.6. Risk parameters look really good, so there's no point closing it out. We're quite happy to just hold it for a bit longer and take a little bit more profit out of the trade. All right, so you can see here, still pretty central, 4% margin on the upside, 6% on the downside. Still got some nice profit potential in the trade. Okay, a couple of days later, we're now up 1,800. Russell's dropped 10 points. Now we're getting a little bit closer to expiry here, so our delta's changing a bit quicker. So only a 10-point change in the Russell, and our delta dollars has swung by about 30,000. Okay, again, that's partly because we're in a low vol environment at this time as well. All right, so call spreads are now worth very little, and the short call delta is only 4. Short put delta is only 10. Position's pretty central, and all our risk parameters look good. Our theta is picking up, so our theta is now 112. So we're getting a lot more time decay because we're getting closer to expiry. You know, delta dollars looks fine. We've got a little bit of positive delta, so we want the market to go back up a little bit. Delta to theta ratio is about 10%, so that's really good as well. So again, we've exceeded our profit target, but all our risk parameters are okay. So there's no reason to close it out. We're happy to just hold on to this for a couple more days. There's our graph, perfectly central, as you can see. Still got a fair bit of income potential in the trade, and it will do quite nicely if the market goes nowhere. All right, so the 2nd of March, you know, another week or so from that date, ended up closing the trade with a gain of 2,400. So really nice trade, pretty easy trade, really. You know, they don't always work out that well, but we made one adjustment. You can see here the first green arrow, that was where we entered. Second green arrow, that was where we adjusted, and then the red arrow is where we got out. So, you know, nice trade in that the Russell didn't move around too much. And this is what I'm talking about. You look back to November 7th and 8th, around the time of the election. If you had entered a condor at the bottom there, and then the Russell goes bang, 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 bang for 5 or 6 days, you're in big trouble on the calls. Okay, so that's the sort of environment that is not good for condors. The environment we had here during this trade was quite good, and massively exceeded our expectations. Really, really nice trade. All right, so next one, 59-day unbalanced condor. Again, on the Russell, this one started on May 23rd. Russell was at 1380. So again, we've had to go a little bit unbalanced. You can see there we're doing our short puts at delta 10.5, short calls at delta 11, and you know, we've only got 7 of the call spreads, but we've still got negative delta. So again, if we had gone with 10 contracts, we would have had significant negative delta, and it starts out as not being quite a neutral trade. Now, I don't mind starting my condors with a little bit of negative delta, because delta and vega tend to work opposite to one another. So if the market goes down, that's good if you've got negative delta, but it's bad if you're short vega, because generally volatility rises as the market drops. So I find starting a condor, another good tip for you guys, with just a little bit of negative delta is sometimes a good idea, because if the market does drop, you're getting hurt on volatility, but you're doing okay on delta, at least initially. Okay, so pretty standard opening position. Again, just going back to the skew there, look at the that last column that I've included there, implied volatility. The implied volatility on the puts is around 20%, and on the calls it's only about 12%. So that's what I'm talking about in terms of skew. Okay, a lot of volatility in the puts, a lot of people buying protection, not much volatility in the calls. So that's why we're having to do unbalanced iron condors to get neutral. All right, so starting position, pretty standard, about 2,500 income potential. Again, we're risking about that 18,000. We've got 6.5% margin on the upside and 9.5% on the downside. So maybe we could have, you know, looking back on it, maybe brought the puts in a little bit closer, and that would have given us a more neutral trade. But, you know, this is how we started out, and let's follow along. So May 31st, Russell is at 1371, so we've dropped a little bit, which has been good with that small amount of negative delta. Trades performed really well, up $700. It's been more or less flat on the underlying since inception. Said here, potentially a good time to take profits. given that a big move in either direction could see the profit evaporate quickly. However, all our risk parameters are okay, and we'll continue to monitor the trade. So, getting close to that $1,000 profit target, there's no reason why, if you've had a good start to the trade, you've got a nice profit, there's no reason why you can't just take the profit, close it out, and start a new trade. Okay, but this trade, perfectly delta neutral, delta of 3, and short puts are at -10, short calls are at 7. So we're all fine in terms of our risk parameters. And what I tend to do when I'm looking at a trade is I look at it and I think, is this a position that I'd want to be in today if I was opening it? And yeah, this trade is fine. It's perfectly delta neutral. Greeks all look good. But now if delta dollars was 50,000 or something like that, I would look at it and say, is this a trade I would open as of today? And the answer would be no, and then I'd want to do something about it. But this trade looks fine. See there, the graph looking really good, 9% on the downside, 7% on the upside. That profit line has come down a little bit, indicating we've made a bit of money. There's about 1,800 left in income potential in the trade. All right, so move forward to June 12th. Russell's jumped up to 14.19. And I've got here that it hasn't taken much to put this trade under pressure. That's the trouble with a low vol environment. Russell has moved from 13.70 to 14.19, and the calls are now in need of adjustment. Okay, so we've only gone up 40 points, not much in terms of percentage, and we're already under a little bit of pressure. So that's where being a little bit careful with your condors in a low vol environment is really important. Okay, so in the last few days, the trade has gone from being up $700 to now being down nearly $300. Delta dollars is at -60,000, which is over 3 times our capital at risk. So that's too high, okay? While the position may be okay for now, any further upside is going to really start to hurt and also makes the position harder to adjust. That's what I was talking about earlier. Better to adjust now while we can rather than when we have to. Okay, so if you look at those 1470 calls, the delta is 20. That's one of our key rules. Our delta dollars is getting up in terms of exposure. Our delta to theta ratio is really high. It's at 50%. So a couple of our rules have been hit, and we're going to adjust. We're going to take some defensive action. Okay. So the adjustment is a pretty simple one. Going to roll the calls up 20 points. Okay, so that's a defensive move. We're rolling them away from the market. That's going to cost us some money because we're going to have to buy back this 1470, 1490 spread, and we're going to sell a new spread further away, which we're not going to bring as much income in for. So it's going to cost us money to make that defensive adjustment. So in order to help pay for that adjustment, we'll also roll the puts up by 50 points. So markets rallied, those 1250 puts, and that put spread hasn't got much value left in it. The delta's only 4.5, risk is very, very low. So we're going to roll the puts up a little bit, helps bring our delta back to more neutral, and also helps pay for the rolling of the call spreads, the delta defensive adjustment we had to make. So here you can see the position. That income line has gone up to 3,000, indicating we're down a little bit in the trade. It's moved up from where we started, 2,600 or so. We're pretty close to that 3% rule on the call side, and we were at delta 20, and our delta dollar exposure was pretty high. So that was kind of 3 of my key adjustment criteria that were hit or pretty close to being hit. So I wanted to adjust. So defensive action, we roll those call spreads out a little bit further, give us a little bit more margin for error. On the downside, we've got 12% margin for error for the puts, and the delta was only 4.5, so I'm comfortable rolling those up a little bit. So here we go. After the adjustment, we've rolled the call spreads out 20 points. Okay, we've gone out to delta 11.7, so that's a nice level that I like to be at. That's cost us a little bit of money. We haven't brought in as much for selling those spreads as it cost us to buy back the other ones. But we've rolled the puts up as well to 1,300, 1280. Again, we've rolled it up to sort of delta 9, another nice level. Brought in a little bit of extra income. It's also helped bring the delta down a little bit. So we've reduced our delta from delta dollars from -60,000 to -20,000. We're still not perfectly neutral, but our exposure is looking much better. Our delta of our short calls and puts is looking much better. Our delta theta ratio is looking a little bit better, and just the graph as well just looks a little bit better as well. All right. So fast forward to June 21st, and the Russell's come back down a little bit, which is good. Condor is up $800 as the market has pulled back, perfectly central with 7% margin either way. We have positive delta given we have more of the put spreads. Okay, so the market dropped a little bit. So we could have had this trade and not made any adjustment at all, and we would have been okay. But as I said, it's better to adjust when you can rather than when you have to. We took a little bit of defensive action. Turned out we didn't really need to, but my preference is to adjust early before the trade gets into too much pressure. So now Russell's dropped back down. We've switched to positive delta now. Again, we're still relatively neutral. Delta to theta ratio is not too bad. Delta of our short puts is 8, and the delta of the short calls has really dropped away, only 3 now. So, not much value left in those call spreads at all. We've got 6.5% margin on the upside, 7% on the downside. So looking much, much better. And fast forward to the 28th, with only $800 in income potential left in the trade, there's not much point holding it for another 3 weeks. The put spreads are tying up 19,000 in margin and only have 250 in premium left. The calls could also come under real pressure if Russell has a further 1 to 2% rally from here. So Russell's moved back up to 1425, so we're getting up towards those calls again. Again, everything looks totally fine, and I probably could have held this trade. Delta of our short puts, okay, that's an important one. It's gone to delta 3, very, very low risk, and we've only got $250 in profit potential. That's the 110 minus the 85. So they're not really doing us much good down there. $250 in income potential, and we'd have to hold the trade for another 3 weeks. It's just not really worth it. I'd rather close it out and open a new trade with more profit potential. Okay, they're also going to give us very little protection. If the market rallies and those call spreads start to come under pressure, we're not going to make much money off those put spreads to offset. Okay, so again, a bit of a judgment call. Risk parameters are all fine, but given the amount of profit left in the trade, how much margin we were tying up, it was best to just close the trade out. All right, so hopefully that wasn't too confusing for you guys. Again, those were reasonably simple trades. It does get a little bit more complicated than that at times, but that gives you a good little insight into how these trades work, and been doing really, really well this year. And a little bit of an insight into how we adjust and things like that. Again, in terms of how to adjust and where to put those strikes, we're looking at delta of those short strikes is a key thing, and also the value of the spread, things like that. I can go into a bit more detail on that later as well. All right, so another trade that I want to show you guys is the iron trapdoor, which is one that I've developed over the last couple of years in this rising market. As I said, a lot of people have had issues with their condors on the call side. Okay, market's rallying, it's the calls that are causing problems for these condors. So I've developed this trading plan, a little bit different. It's an adjustment on a condor, a variation, and it's been working really, really well. It's a much slower moving trade than a condor. So we've got those really short-term condors that move around a bit. You've got the longer-term condors that are a bit slower. The trapdoor's even slower. Okay, so it's really, really nice trade. Again, trading plan, we're trading the Russell only on this one. I've got some guys who have used it on other instruments as well, but typically I'm just using the Russell. We're allocating about 20,000. Trading style, 20 to 30 days left to expiry. I'm actually, again, going a bit further out with these as well. So again, same as the condor, you go a little bit further out in time. They're a bit slower moving as well. Now, this trade handles most market environments really, really well. But the worst case scenario is a fast move down, and that's due to rising volatility. Usually it's not going to hurt as much as the condor, but sometimes it can be pretty similar. A fast move up is going to hurt the calls, but we contain the damage by rolling the calls out, increasing the number of contracts and also rolling up the puts. So it handles an up move really well. You'll see in a minute, we trade less of the call spreads. Okay, so the worst thing that can happen is early on in the trade, the market goes down really quickly. That's going to be bad for this trade. If the market goes up really quickly, it's not as bad as what would happen on a condor. You can handle it really, really well, and you'll see why. The best case scenario is that the Russell drifts sideways for the first 7 to 10 days before slowly moving down to the profit zone. So you'll see this is a profit zone that we're creating with this trade, and you'll see that in a second. We'll just go through the rest of the trading plan. So similar to the Condor short strikes, anywhere from delta 10 to 15, even as low as 8, but sometimes that's a little bit lower, too low. What we do is we add a debit spread, so a put debit spread, and we open that 10 to 20 points below the current market. Strikes are 20 points wide for all spreads. We want to enter it for at least a small credit. So I look to enter this for at least a $500 income potential or credit. Try and enter it when there's a volatility spike, a little bit of a sell-off. So that's always good. This one is not going to hurt you as much if you end up getting in right at that bottom and you get that V reversal. This trade will handle it a lot better than a Condor will. Exit guidelines: if price gets to within 10 points of the short strikes, stop loss of 5%. Otherwise, if neither of the above are met, we can actually hold this one to expiry. Adjustment guidelines, somewhat similar to the Condor. Short option delta hitting 25, definitely want to adjust. We don't want it to get above that level. If delta dollar exposure reaches plus or minus 50,000. So again, that's about 2.5 times the amount of capital that we're risking. So pretty similar sort of rules here. 2-3 times what we're risking is when we want to adjust. All right, so let's look at the trade and how we set it up. So again, this is something that I'll cover in a lot more detail, but a couple of examples to show you. This was from Feb 28th. We've gone out 52 days, and the initial setup is perfectly delta neutral, which is good. However, market's looking a little overbought and a little toppy, so we did talk about trading the 8 put credit spreads instead of 10 in order to start the position, should say, with slightly negative delta. But this one, perfectly delta neutral. You look at that, delta of 0. So perfectly neutral, gamma of 0. We've got less gamma risk with the trapdoor, less price risk. Vega is also a lot lower. If you go back and look at those Condors when we started them out, Vega was up around 370. Okay, a lot less Vega risk. A little bit less time decay, and that's the offset. Okay, that's the compromise. Delta dollars, $665, so perfectly neutral. So here we go. What we do is, the first thing I do is I start with a put debit spread. So you can see here I'm buying 2 of the 1370s and selling 2 of the 1350s. So it's kind of opposite to what we normally do, right? Russell's at 1385, so I'm going 15 odd points below, and I'm buying a bear put spread, which is going to do well if the market drops. Then I go out on the put side further and I sell my standard 10 at roughly delta 10. Okay, this delta was 120 on those short puts, so this would have been delta 12. Okay, I also sell 2 call spreads, again pretty similar, delta 10, 12, somewhere around that level. And what I do is I kind of tweak the trade a little bit. Sometimes I might trade more of the put spreads or less of the put spreads. I might trade 8 or I might trade 14 to try to get it to perfectly delta neutral. So I do have a little bit of flexibility with the trade. Okay, this is kind of an advanced trade, guys, if you guys are beginners, so don't worry too much. I've got lots more information I can give you guys on this stuff. But that's the initial setup, and you'll see the graph here. You can see this nice profit zone that we've created on the downside. So even though we've only got $500 income potential in the trade, if it stays flat, we've got this really big profit zone on the downside. As I said, we don't want the stock or the index to go down into that level early in the trade. We want it to go down into that level towards the end of the trade or halfway through the trade. You can see on the call side, we're only trading 2 of those call spreads. So we're only risking $3,500 on the upside. Okay, whereas we'd have the $18,000 on the downside. So that's why we don't want the market to drop really quickly. That's the worst case scenario. But again, it's a pretty neutral trade. You see that purple line, we've got 3% margin for error on the upside and about 3.5 on the downside. So, we do want it to trade neutral. That purple line also is a bit, it's not quite as steep as you would see on a Condor, so it handles those initial price moves a little bit better. Yeah, you can leg in. I tend not to. I tend to just open it all in one go. And again, I'll layer into this trade as well. So, you know, I might enter one on a Monday, 25% position size. I'll enter the next one the next Monday, 25 position size. I'm just kind of scaling in like that. You can leg in, but, you know, again, I don't tend to do that. I tend to just open it all up in one go. All right, so we go forward to March 3rd. Russell's at 1395. Position's done really well. It's up 350. Well positioned with low risk Greeks, and the purple line on the next graph is 1 week from today. So we got delta of -6. So the market's gone up a little bit. I can't remember where we started. 1386, I think. So we've gone up 10 points. Delta -6. Delta dollars -8,000. Totally fine. Delta of our short puts is 8. Short calls 10.5. So risk parameters totally fine here. Okay, so here you can see the trade's changed a little bit. That income line has come down a couple of $100, indicating we've made a bit of money in the trade. Okay. Further upside's going to hurt us a little bit. We prefer the market to start going down a little bit, but generally very, very neutral. Move forward a couple more days. Similar to the March trapdoor, which was another one we had. Lots to learn from this trade so far. Somewhat interestingly, we've already made the entire premium or income potential in the trade in just over a week. Okay, we received $595 in premium, and the trade is currently up $680. So the horizontal line has actually dropped slightly below zero. This is a really good result considering we are just over a week into a 52-day trade. So again, you've got to look at you know, the position and say, well, how much money have I made? How much income potential is left? And how much time has passed? If you've made a really nice profit and not much time has passed, perfectly okay to stay in the trade. That's to take profit, sorry, and open a new trade. So, yeah, looking at this one, perfectly delta neutral, short puts -10, short calls -5, really, really low risk trade at this point, and we've made a nice profit. So you can see here that risk graph has dropped down even more. So if the Russell stays flat from here to expiry, we're actually going to give back a little bit of that profit. That's what that's showing. Okay. But 1 week from now, it actually can drop even further. So you can see that purple line, we can actually make a little bit more money if the Russell stays flat. And what happens if we do hold it into expiry and we start to drift down into this zone, 3-4% lower from here, we can actually get into this profit zone and you can actually do really, really well. All right. So someone asked, how do I leg in? So typically, you know, I'll set up the 3 orders, and the most important one to get a good fill on is the 10 contracts because you're trading the most. So I'll put the most effort into that. Once that one's filled, I'll quickly fill the other 2. There are only 2 contracts, so you're not going to get hit too much with slippage. All right, so go forward to March 9th. Trade's up 725. So again, you're looking at that initial graph, we had $500 income potential. We've actually made more than that because the price has gone down into that zone. Income line has dipped below zero, which is a great result this early in the trade. The income potential was 600 and we're up 725 with very little income potential left in the trade, and we're still 6 weeks left till expiry. I'll close this out here and start to look, start a new trapdoor with more favorable income potential. So, you know, again, all our risk parameters are fine. If I go forward to the next slide, you know, we could hang in on the trade and potentially make money. I could have definitely held on to the trade. There was really no reason to close it out other than the fact that, you know, I had a nice profit on it very, very early in the trade. So my thought process was that, you know, I'll close it out and I'll start a new one, get that income line back up to $500. Okay. All right, so second trapdoor case study that we're going to look at. Credit received on this one, again, 614, around that sort of $500 to $600 that I'm looking for. Capital at risk is 15,000. Delta's pretty neutral. Delta's 2, delta dollars 2,800. You know, again, delta of the short puts is about 10, 11. Short calls is about the same. You know, we're buying that put spread 20 points below. You know, sometimes I'll do 10 points below, sometimes 20 points. Depends how I want to sort of structure the trade and what my outlook is. But, you know, this is a pretty standard setup. Okay, so similar to the last one, we've got that profit zone on the downside. We've got the $500 to $600 income potential if we stay flat, and we've got low risk on the upside. Okay, so go forward to April 17th. Russell hasn't really gone very far, slow moving trade. We're 3 weeks into the trade and Russell has barely moved. The trade's up $300 and all our risk parameters are fine. Delta of the short puts is -12 and short calls is 4. Delta dollars is only plus 7,000, so that's also totally fine. No action needed at this stage. So again, these trades are just really, really slow moving, which is great for those that don't want to be stuck in front of the computer all day. Okay, so you can see that income line's come down a little bit. Pretty standard looking trade still, and a trade that I'm perfectly happy to stay in. I've got a little bit of income potential left, and risk parameters are fine. Okay, so Russell now has jumped up a little bit to 14.11. So while the position has not yet hit any adjustment points, I feel it's best to get it back to delta neutral in this market. So I was worried about the market rallying. First, the defensive move. So we roll the calls up 10 points. We roll them from 1460, 1480 to 1470, 1490. Also increasing size to 3 to help pay for the adjustment. Doesn't increase our risk by much, and the adjustment doesn't cost us anything. Actually gives us a credit of $10. Also rolling up the puts, because the 1260 puts are at delta 2 and the spread has only $200 in premium left. No point tying up all that capital for 3 weeks for the sake of $200. So I rolled the puts up again, aggressive adjustment from 1260, 1240 to 1300, 1280, brought in an extra $200 in income potential. So I'll do stuff like that with these trades as well. And also another adjustment that I like to make is selling one of the put debit spreads. This reduces our profit zone or the trap on the downside, but with the markets looking strong, I think it's unlikely that we'll drift down into the zone. So selling the spreads puts another 150 in our pocket, and overall the adjustments brought in an extra 410 in profit potential and got us back to delta neutral. Okay, so a couple of moving parts there, 3 sort of separate adjustments. We're adjusting all of the spreads, but you'll see it kind of makes sense. So here we've got delta of -13, -18,000. That's our position, getting a little bit close on the calls. Negative delta, so that purple line there, we want the market to go back down. After the adjustment, we're back to slightly positive delta, more or less neutral. Okay, we've sold one of the debit spreads, so that trap has got significantly smaller, but we've significantly raised the income potential in the trade up to now 1,000. Okay, so that's something that I like to do. We've also moved the call spreads out, so we've got a little bit more margin for error if the market rallies. Short puts are at delta 5.5, short calls are at delta 11, so we're all good. All our risk parameters look good. So it was the 25th, another week goes by. Trade's worked out well, currently up 500, pretty close to the maximum income potential in the trade, or the initial trade. Represents a return on capital of 3%. The position has gone up $300 in the last week or so, and I would take profits here. Okay, so that one worked out pretty well as well. So obviously, lots of stuff we've covered there in only a couple of trades. But hopefully you guys can kind of see my thought process and how some of these trades work. There's I could spend days talking about this sort of stuff. There's just so much to cover. But I hope you guys got a lot out of that. So for me, option trading has been life-changing. It's absolutely awesome. And it certainly has been for me and for some of my students. And I strongly believe that if you're here today, you have the belief, the desire, and the will to become a successful trader. And this is something that you can get started on today. So nothing I've shared with you so far is theory or what might work. This is exactly what I've done to achieve consistent returns year on year. And I've helped hundreds of traders achieve their goals of becoming successful traders. So I've been teaching traders since 2010. Okay, I've been doing this a long time, been trading since 2004. Doesn't matter if you're just starting out or if you've been trading for a number of years, it's all about making a strategic plan and implementing it step by step. So how would you like to earn consistent monthly income from the stock market for the rest of your life? So I've shown you the strategies that I use in my trading and how you can use these strategies to finally make the jump to being a pro trader. So I've walked you through the exact strategies that have helped me consistently earn 12 to 24% per year. Again, you can earn more trading options, and a lot of people, there's a lot of hype out there. You guys know me as the bullshit free guy, right? So I keep it real, I keep it honest. yes, you can make 50, 60% returns trading options, but you have to take on a shitload of risk to do that. It's finance 101, right? If you want to make a 60% return, you're taking on a lot of risk. You've got to accept a really big drawdown. So I tend to aim for that 1 to 2% a month, and I have much lower drawdowns when things go against me, okay? So you guys are my VIPs being on this webinar, and as of now, or after this session, I'm going to be opening up my group mentoring program once again. So this course has helped hundreds of traders, and I've spent the last 6 months making it bigger and better. So I'm expecting big things from the next intake of traders. Okay, we've got a really great group. So why are you here today? Not sure why you showed up, but maybe you've experienced some of these common problems. You have a good winning streak, but then you give it all back with one bad loss. So that's something I see happening a lot. You're struggling to know when to enter, adjust, and exit trades. So we talked about that a lot today, but in the course I go over that in a lot more details. You're chopping and changing from strategy to strategy. Okay, so that's another thing that people are guilty of. A lot of beginners make that mistake. You don't cut losses early enough. You're not disciplined or patient. So maybe you're making one of those mistakes, or maybe more of those mistakes, more than one. So you've got 3 options. Number 1, you can figure it out all on your own. Most people take this strategy. They don't want to fork out the money for coaching, or they want the challenge of figuring it out themselves. I took this route for many years, trying to piece together information from books, internet forums, YouTube videos, etc. I wasted years taking this approach. Okay, I understand, like I've been there, did it myself. I understand where you're coming from if that's the way you want to go, but if I had my time again, it's certainly not what I would do. There's a lot of free information out there, but trying to piece it all together into a step-by-step system is very difficult. It's almost overwhelming now, the amount of information. When I first started, there wasn't much information out there. Okay, there's so much information out there, and there's a lot of sketchy people out there as well. So you've got to be really careful what you read and what you take on. Okay. As I said, there's nothing wrong with taking that approach. I get it because I've been there and done that. It'll take much longer, but if that's what you want to do, totally respect that. Option 2, you could sign up for a different program. Again, as I said, there's lots of other people out there who can teach you this stuff. I totally respect if that's the route you want to take. Other programs sell for a similar price, but they're mostly recorded videos, and you're completely on your own. You don't get the opportunity to ask nearly as many questions. With my mentoring program, I'll literally hold your hand until you reach your trading goals, and you'll get unlimited access to pick my brain. Some other programs also require a monthly fee, some as high as $200 and $300 per month, okay? Crazy. So let's assume you join and it takes you 1 year to really get it and turn pro. That's if you're lucky, right? So 12 months times $300, that's $3,600, okay? And that's just for 12 months. What if it takes longer? What if it takes a couple of years, 2, 3 years? It's a lot of money to fork out. So step 3, you could sign up for my program, have your hand held as I walk you through a step-by-step blueprint to becoming a professional trader. It's one payment and it's lifetime access, so the choice is yours. So why aren't you successful? Which route are you taking? Are you taking the route on the left, the nice, efficient Tesla, or are you stuck in the old Mr. Bean car, the inefficient way? Okay, so that's the choice you've got to make. Which route do you want to take? So what is the course exactly? It's a step-by-step course that walks you through the entire process. Okay, so all of the stuff we've talked about in these 2 sessions, we go over in a lot more detail. Okay, you can log in 24/7, so as soon as you've made your payment, you get access. It's all digital and downloadable. There's 11 modules with more to come. It's literally step-by-step. Nothing is left out. So I'm going to condense 14 years of trading experience into just what you need to know. There's no fluff, there's no BS, but nothing's left out. It's all the important stuff, okay? And also there's a great community of traders going along with you to help you and support you and share your ideas, okay? So a big believer in simple steps. Everything should be made simple as possible, but not simpler. So again, 14 years worth of experience, I've condensed it down into just what you need to know. So the 11 modules, we've got condors, we've got trapdoors, we go through that sort of stuff in a lot more detail than we did today. Weekly diagonals, this is another strategy I use. Bearish butterflies, the wheels, strangles, and weekly butterflies. So those are kind of the 6 core strategies that I use. So I go over those in a lot of detail. Also got a module on technical analysis, so we haven't got time to cover that today or last week, but I go through all of the key things that I look for. Again, it's not overwhelming. I just give you the key things that I look at, okay? Trading psychology, so we talk about that. You know, it's really, really important. Talked about, you know, little things that beginners don't do, like having a trading journal and a trading plan, and how much of a difference that can make. So some of my guys have you know, started doing that, and it's just made a phenomenal difference to their trading. Module 9 is all about volatility, so we go over that in a huge amount of detail. And number 10 is quick tips. So again, just some of those little tips and tweaks and things that I've learned, I just kind of condense them down into a brief session and get those tips for you. The 11th module that I added, didn't fit it on here on the slide, but that's on gamma scalping. Okay, so really cool strategy that market makers use. Really, really powerful strategy. It's also a really good hedge for some of those neutral trades like condors and trapdoors that, you know, if the market crashes, that's going to really impact your condors, but if you've got these gamma scalps and long strangles on, that can help to offset. So I'll talk a bit about that. I've also got some more stuff planned. The course just continues to get bigger and better as we go along. So I've got a big module that I'm putting together on ratio spreads, and I'm also doing one on a bonus session on strangles, on inverting strangles, so a really cool strategy for managing short strangles when they get under pressure. So lots of good stuff coming in addition to the 11 modules that we've already got. So who's the course for? It's for those who want to learn how to trade profitably no matter what the market conditions are. It's the beauty of options trading and delta neutral trading. You know, if you're just investing in the stock market, you're only going to make money if stocks go up. Whereas with options trading, you can make money in up, down, and sideways markets. So it's for anyone who is looking to take their trading to the next level and reduce their learning curve. You're looking to build serious wealth over time. This isn't a get-rich-quick thing, guys. This isn't sign up for this course and you're going to make millions of dollars in the first 6 months. This is a process. It's a marathon, not a sprint. So you're wanting to build wealth over time. You're emotionally stable enough to handle the ups and downs of being a trader. It's for those who want to be a trader but don't want to spend all day stuck in front of a computer screen. To be honest, I couldn't think of anything worse. I don't know how people day trade. It would do my head in. I couldn't sit there all day. I have a really good strategy that requires me to not even look at the markets much. And it's actually made a big difference coming out to Australia because I'm not in front of the markets all day. I'm not over-analyzing things. So, you know, that's a really good thing to do in terms of that trading psychology I was talking about. You know, you just check the markets once a day. You just log in the last hour of trading or the last half hour of trading. You check your risk parameters, you check your Greeks, and if everything's good, you leave it. If you need to adjust, you adjust. It's for those who are looking for a step-by-step system that has been proven to work. And it's for those that are committed to spending the time it takes to be successful. Despite what a lot of people out there will tell you guys, it's not easy. It's very, very hard. It's, what's the saying? It's the hardest way there is to make easy money. Okay, so you've got to be up for the challenge. Okay, that's important. All right, so imagine being able to spend more time with your family, having more time to go on vacation. Imagine being able to make a living working 1 to 2 hours per day. Imagine being able to quit that dead-end job and never work for someone else again. Imagine when people ask you what you do for a living, imagine being able to say, I trade options for a living, or I'm a professional options trader. It's pretty cool. If you like the sound of that, then this course is for you. So who's the course not for? As I said, get-rich-quick schemers. It's a slow and steady process. Okay, it's not for complete beginners. You've got to have a basic understanding of options. If you've only just recently found out what a call and a put is, not only has most of the stuff we've talked about today gone completely over your head, the course probably isn't for you as well. You need to have a basic understanding. For those that have been already trading professionally for more than 2 years, now I'm sure if you are a professional trader, you probably will still get little tidbits out of the course. But if you're already trading professionally for more than 2 years, course probably not for you. Anyone who's looking for a holy grail or black box trading system, that's not what this is. and people that do not have their financial house in order. So if you've got a lot of credit card debt, if you're under financial difficulties that's causing stress for your family, I don't want you in this course, okay? Get your financial house sorted out first and then come and talk to me. All right, so what are other people saying? As I said, Brad owes his dedication to a trading journal and trading plan to Gavin, and as long as I stick to it, I seem to make money. Dick says Gavin is a no-nonsense, transparent trader who breaks down difficult topics into easy-to-understand bits. The best part, he shows you how to minimize risk while maximizing upside. I highly recommend his course. And Chris, with Gavin's help, I've gained confidence in my trade so much that I was able to get a 30% ROI on my last bearish butterfly. It's hard to find another mentor that can produce such amazing results. So the other great thing is that you're joining a community of traders. Okay, so we've got a great Facebook group going. As you can see here, I won't go through the comments, but we've got people coming in here every day and sharing ideas and asking questions, getting feedback. I'm in there every day also sharing thoughts, giving feedback, just providing little tips and tricks as well. So really, really great community. Again, not everyone's on Facebook. I've got one guy, and privacy can be a concern as well. I understand that. So I've got one guy who just signed up for a Facebook account under an alias so that he can come in and interact. That's totally fine if you want to do stuff like that as well. But really, really great community of traders that we've got going on. We've also got the $1 Million Challenge. So I've set myself a challenge to help you guys make $1 million in trading profits. Okay, so that's people coming through the course. Now you can see here we've got 11 traders so far who've shared their details. We've got 2 guys who've made a loss in the first 6 months, one guy basically flat, but everyone else has done really, really well. You can see I'm over 10% of the way to my goal already. So I'm going to have to up this, I think, at some point to the $10 million challenge. Now, part of this as well was, that I wanted people to try to commit to donating 10% of their profits to charity. So if we can hit $1 million as a group, that's $100,000 for charity, which I just think would be amazing. And then if we end up, get a few more traders in the group, if we can get a $10 million challenge going, that's potentially $1 million that collectively we could raise for charity, which would be absolutely amazing. So, some amazing results so far. Really, really happy for these guys. And look, I'd love for you guys to be part of this group to help us reach this goal collectively, and also your personal goals as well. So here's a little sneak preview of what the course looks like. So inside, you come in, you've got all the modules on the right there, you get all the trading plans, the adjustment guides, you get access to all the slides and everything. So all the information, come in, download it 24/7, all the bonuses there, which I'll talk about as well. And we also have a weekly session. So we've got case studies that we're doing, lots of different case studies open, all these closed case studies, some of them we've talked about today. So we keep track of those in a sort of journal format with comments and screenshots, and a little summary here of some of the trades that we've closed out. Some of these have done really, really well. Okay, so lots of stuff going on. It's not a 6-week program or a 12-week program or anything like that. This is ongoing. This is something that's going to be going on, indefinitely. All these case studies and a weekly session where we talk about what's happening in the markets. We talk about the case studies and what's happening. And anything else that I want to share with you guys, anything else that I'm working on. So you're kind of getting into the inner circle a little bit. So, some of the stuff that I work on that, might not hit the public blog for a couple of months or 6 months, you guys get access to that straight away as I'm working on it, things that I'm looking at. So that's really cool as well. Okay, so again, weekly Q&A and strategy sessions. So again, all the replays here from earlier in the year. We do this every week. I do take a couple of weeks off a year. I had a bit of a vacation in June, July. I took 2 weeks off, but other than that, we're on every week. We're talking about the case studies. We're talking about the market in general, any other ideas and strategies that other people bring up, or anything that I'm looking at as well. So, a lot of information that we're getting together that you guys can go back and look through. If you want to watch some of these old sessions, or if you just want to come along to the live session each week as well. As I said, pick my brain. We're usually on for an hour or so. you can just come in and ask as many questions as you want, and obviously email. You can hit me up on Skype as well anytime. So it really is sort of inner circle access and a great group that we've got going on. So we've got some bonuses as well as part of the course. We've got the iron condor adjustment guide. So again, those 10 different strategies for adjusting iron condors. So I'll go through those in a lot of details. Member tools spreadsheet. So all the spreadsheets that I use for my trading, you get access to that. Profit tracking spreadsheet. Some of you guys may have that already. You get that, so you get access to me 24/7 on email and Skype. The $1 Million Challenge, obviously talked about that one, and the private Facebook group. That's a closed group, by the way, so only people within the group can see it. It doesn't show up on your news feed or anything, so your friends and family won't see what you're in there talking about. It's all closed off. So those are the bonuses, and obviously the case studies as well. So quick recap. We've got 11 modules, we've got the 6 bonuses, including the Facebook trading group. And I do also offer guys an unprecedented, nobody else does this, 30-day, 110% guarantee. So if you sign up, you find out you don't like the course for whatever reason, I'll give you your money back. And not only will I do that, I'll give you another 10% out of my own pocket. I'm that confident that you guys are going to love this course and this program. So for any reason within that first 30 days, if you don't like it, if you decide it's not for you, no questions asked, I'll give you your money back plus another 10%, and obviously lifetime access, so no more to pay. I am going to be raising the price, so I've actually raised the price last week, but for you guys, as I said, as VIPs, you're going to get access. This will be the last time I'll be offering the course for this price. Okay, so if you want to sign up, there's the link there. I'll put that in the chat as well. So you can go and check that out. It's going to be closing on Sunday, okay? I can't take too many traders in, so I only open it up a couple of times a year. As I said, I like to keep this group pretty small so I can give a lot of personal attention to you guys. So let me see if I can just pop that address into the session here. All right, so go and check the page out. As I said, just make sure you're in the right place. Here we are here. This is the sign-up page. So there's our countdown modules. You're in the right place if you're on that page, okay? I said screenshots here, what it looks like. So the payment, it's a one-time payment of $9.97, which, as I said, other programs out there, you're not going to get nearly the level of service that I'm going to give you guys, and you're going to pay a lot more, okay? As I said, the price has gone up to $12.97, but as VIPs on this webinar, you guys can get access on the old price of $9.97. Okay, so you hit the Join Now button when you're ready and put in your details. You choose a username and password, email address, pop your card details in. Once you hit that, you get access straight into the course. As I said, 30-day, 110% guarantee. So once you put in your details, you get a little confirmation screen, link to watch the welcome video. You'll get also emails with your access details, things like that, and you've got access to everything, okay? So there's the dashboard. Once you log in, there's the welcome video. You can register for the weekly webinars, okay, and access to all the modules and all that straight away. All right, so the other thing I'm going to do for you guys as VIPs, the first 5 people who sign up are going to get a one-on-one session with me as well. Okay, so sometimes you might not want to ask your questions in a group setting, things like that. I understand that. So, I want to reward people who take action. So the first 5 people who sign up will get to have a little chat with me, a little coaching session, one-on-one. All right, any questions, guys, on any of that? I'd love to see a few of you in the course. As I said, price has gone up, but you guys will get access at that old price. Closing on Sunday, and yeah, next time the price will be up and won't be open again for a few months. Okay, so then we've got some questions here. Webinars are on Wednesday night. I think 9 p.m. New York time, but every now and then I also switch it up a little bit so the guys in Europe can come on live. So if you're in Europe, that's also possible. So we do that once a week, lots of case studies and analysis as well. All right, guys, I'm going to take a little pause, but I'll hang around. If there's any questions, shoot them through in the question box there. We've got a couple of people signed up, as I said. You know, the first 5 who get in will get that that extra session one-on-one with me. So yes, you can use PayPal. And what time is it on Wednesday? 9 p.m. But then in the winter, Northern Hemisphere winter, it'll go to 8 p.m. Again, as I said, you know, every couple of weeks I do switch it up. So if you're in Europe, you know, I'll do it in the evening my time, so sort of lunchtime your time or morning for the Europeans. All right, guys, we've got 2 more spots left for the VIP, the first 5. So if you are thinking about it, those are going pretty fast. So the 3 guys who've signed up, I'll email you with some available times, and then you just let me know what works for you as well, and we'll get on and have a chat one-on-one. Now, if you prefer, what you can do is you can go through some of the material first and sort of build up your questions. That's totally fine, or you can just get into it straight away and we can chat later in the week or next week, whatever you want to do. Okay, so I'll be in touch for those guys that have joined already, which is awesome. Actually, the other thing I did last time, which I'll do again, when I did a VIP launch, is I had 2 $200 Amazon vouchers that I gave away randomly. So I'll happily do that again. So 2 $200 Amazon vouchers, and I'll just draw those randomly out of a hat or whatever. So yeah, if we only get a few people signing up, again, I like to keep these groups pretty small. You got a pretty good chance of getting that $200 voucher, and then you can use that to, get all the trading books and things that you want to get. I've got some recommended reading that I can send you guys, but I'll just give you that voucher. You can choose it anyway, spend it any way you want. It doesn't have to be on trading books, although certainly a good idea and what I would recommend. Awesome, Bob. Very good. Yeah, looking forward to chatting to you as well. Yeah, exactly. So we do case studies. So, for example, we'll put on a condor and a trapdoor at the same time, and we'll follow them along, and we'll compare how the 2 perform. And, maybe the condor needs adjustments. I'll talk about that and how we adjust it. If we only sort of chat once a week on the webinar, so if there's something important that happens and something does need adjusting, I usually shoot a quick video and send that out to everybody saying, this is what's happened to the trade, this is why it needs adjusting, this is how I'm adjusting it. Okay, so and then we'll talk about it in more detail during the weekly session. Okay, so we're doing lots of that sort of stuff. All the other strategies as well: bearish butterflies, strangles, diagonals. We typically have around 4 or 5, 6 case studies at a time. We don't want to have too many and overwhelm you guys. The other thing we've done is we've had a 30-day condor and a 90-day condor. We've put them on at the same time and we've compared how they've performed. The other thing we've been talking about a lot recently, see if I can find you some examples, is not that one. Is stocks that have been gapping down on earnings. So we've been talking about that a lot. So here's an example: IBM, big gap down, 6%, and then it trades sideways for about 2 weeks. Okay, another big gap down over the course of a couple of days, and then sideways to slightly higher over the course of a couple of months. So this has been a really nice thing that's working out well. Again, with those ratio spreads, I had some information on the public blog there a few weeks back, but that's something that we're diving into in a lot more detail in the course as well. Something that's been working really, really well this year. Just trying to find some other examples of that. OIH, not that one. Costco was another one, sort of gap down, pretty aggressive selling, sideways for a week, down, sideways. That can be a good one. Netflix on the opposite side, gapping up after earnings. Where are we? Netflix. Big gap up after earnings, and then look at that sideways over the course of 2 weeks. So that's a couple of case studies we've got on Netflix at the moment that we're looking at. Just trying to think of some other examples. Target was another one I've done a lot on. Have to go back a little bit further in time. But big gap down on things. It's updating here. Big gap down, 13% down, sideways to slightly lower over the course of a couple of months. So you can do really, really well with, neutral strategies can do okay. Ratio spreads do really, really well in that environment as well. Again, same example, big gap down, and then sideways over the course of a month or so. So that's something that I've been looking at a lot this year. BMY, someone's asking about. Yeah, I mean, technically, not too much going on, sort of struggling at resistance here. Again, go over it in more detail in the technical analysis module, but a few key things that I look for: 50 and 200-day moving average. Are we above the 50? Are we above the 200? Above the 200 and above the 50 is generally bullish. 50 above the 200 is bullish. If a stock starts to break below the 50-day moving average, that's kind of the first shot across the bow. It's a bit of a warning sign. Once it gets below that 200, that's the signal, right? Might be time to get out of this one. So that's one thing I look at. This chart's a little bit all over the place, and again, not something that I've really traded in the past. So I haven't got too much of a comment on it. The other thing is divergence. So this is a really important one that I talk a lot about. So here we've got Costco as a stock we've been watching recently. So divergence is, here we see the price is making a lower low, but the indicator is making a higher low. So there's been a lot of selling here in this stock. All of a sudden the momentum is starting to slow down. Okay, so the selling is not as aggressive as it was. It's breaking to new lows, but the indicator is not confirming the new lows, and then sure enough, bang, up 7% over a couple of days. Now you've got earnings in here and stuff as well, and I try to avoid stocks over earnings if I can, but this is a lot of stuff we talk about in the weekly sessions as well. I don't share my exact trades just for regulatory reasons. I can't do that being based in Australia. Very, very much a nanny state here. A lot of rules around that sort of thing. So I can't provide financial advice. I can't provide trading recommendations. But what I can do is have these case studies that we're looking at. We can go back and look at old case studies. I have some software called OptionView, which is really cool. Has some really cool backtesting functionality. So we'll go back and say, right, 2015 or whenever it was, August, markets sold off really hard. How did iron condors perform during that period? So we'll go back and do that. And then we'll have case studies that are live in the market as well, but they're not trade recommendations. I'm not saying go out and make this trade. It's just for educational purposes. So I'm not providing alerts. I'm not telling you guys what to trade, and I'm not telling you what I'm trading. I do talk a little bit about trades that I have on, but I'm not sending alerts and things like that. So it was a good question. All right, guys. So we've got the five. We've got the five VIPs. So I'll be in touch. That's awesome. Be in touch with you guys, and hope to see a few more of you in the course. As I said, it's a small group, so lots of personal interaction with me, and yeah, got big hopes for you guys, and hopefully you can make some really nice profits and get me a little bit closer to that $1 million goal. Okay, at 79, will I be able to keep up? Not sure. That's up to you, I guess. It's I like to think it's fairly slow paced, and you've obviously got the videos that you can go through in your own time. So it's totally up to you. Again, if you want to try it out and you find it's not for you, that's fine. I'm happy to refund your money. Don't worry about that. All right, guys. Well, it's been my absolute pleasure to walk you through some of this stuff. I hope you've really enjoyed it. Even if you don't sign up for the course, I hope you got a lot out of these 2 sessions. And for those who are thinking about the course, I hope to see you in there. There's lots of great stuff going on. And if you join the course, if you don't, email me anytime. I'm always happy to help. And you guys enjoy the rest of your day. And I'll talk to you soon. Yeah, cool, David. No problems. We can chat about that. No worries at all. All right, guys. I'll sign off. But any more questions, feel free to shoot them through. Cool. Have a great day, guys. Take care.